What's going on, guys? Hamilton here with the Trading Initiative, and what we're going to talk through over the next 10 to 15 minutes is just our viewpoint on the growth sector, the state of the market in general, how we were able to catch some of these awesome shorts going back as far as 3 to 4 weeks ago, and why there could potentially be some incoming further drawdowns, specifically within the growth sphere of the market.
Could have been on Wall Street, should have been on a ball team. Could give a fuck about y'all team, cause I don't really feel none of y'all. Morphine, Wall Street.
First off, we're going to want to look at the Qs here. The first real sign that we knew something was going wrong with the Qs was way back in January when we started to break this pattern of higher highs. This is trading technically 101, right? As soon as you stop hitting higher highs and higher lows, at the very minimum, you don't need to go short, but you need to exercise caution in the market. We took note of this dip below the 350 area. This was the first prevalent lower low that the Qs had actually placed in with any sort of volume, essentially during the entire run up from the COVID crash. So we were already in caution mode here in January. We weren't necessarily looking to go short yet, but we were deciding as a group, let's not necessarily go long anymore. We can pick our spots if we find some relative strength, but this was the yellow flag. If you're privy to the Dow theory, you know that a yellow flag means either stop trading, not necessarily going short, not necessarily selling all of your positions, but stop opening up new positions, specifically with size. So if they wanted to take smaller trades, in isolated pockets of relative strength, feel free, but as a group we stopped going long with size in tech at the end of January. Now we drew these fib levels based off of the COVID highs and lows. We just wanted a general idea of where we can place our risk on, risk off levels. If we were to break above 400 and start to trend up there, we wanted to continue to go long with size and tech, but obviously we didn't. So therefore, our next level to the downside was somewhere around this 33676 area. We decided as a group, if we were below 33676, we wanted to start looking at going short. Now we had an area here where we did go short, and a lot of us got stopped out on those short positions as we did bounce back up to 365. That's okay. Every single time we take a new tranche of shorts, we have to understand that the previous position should not impact the future position or current position that we're looking to get into, right? So we once again broke below 33676 and we started to look at what in the market was leading the drawdown, and we started to go short. We're going to go over those names in a second. Moving forward with the Qs though, depending on where your levels are, our next level is down here at 27330. You know, this is another level where we expect some significant support, and then potentially another flip to the downside where shorts can once again reload. The problem with going short here is we are already so far extended through the move, the drawdown, based off of a level standpoint, that right here we're in the middle of where the Trading Initiative wants to be short. Opening shorts here is incredibly risky, because at what point on the chart are you wrong? Are you wrong above 300? Well, you're right there anyway. Are you wrong above 310? Are you wrong above 320? You know, you're giving yourself a lot. You're opening yourself up to a lot of risk here by opening up shorts. The time to short was either at the 33676 area breakdown or this consolidation phase. Right here, you're opening yourself up for a potential rip to the upside. The market loves to take out the side of the trade that is crowded. Right now, everybody is bearish right now. Everybody is trying to chase shorts. You're in a highly volatile environment. You're paying crazy premiums on puts. You know, this is just a very, very risky area to continue to try to open shorts. If you're already in shorts, enjoy the ride. Obviously, momentum is to the downside. The trend is still pointing down towards this 27330 area, but opening up new shorts here can be very, very risky depending on where you want to get stopped out and what your R to R is. RSI is oscillating between the 50 and the 0, which is what we like to see within TTI for a bearish momentum regime. So the Qs are giving us everything we need to know to continue to hold our shorts, and we're going to go into those in a second. The next industry I want to show you guys, well, sector rather. QQQ, obviously we know, is the big indice for growth names. XLK tries to only focus on the tech names. Think like Apple, Microsoft. A lot of the actual market leaders are within this XLK area. As you can see, the chart looks relatively the same as the Qs, but you are going to have a little bit more over dramatic, if you will, moves because it is a more concentrated ETF. QQQ has a lot more exposure to different names. XLK does not. So XLK is mainly Apple and Microsoft. Those are the two biggest holdings. And we know, if you look at Apple really quick, that Apple and Microsoft have held up reasonably well, right? So Apple has not drawn down as much as the Qs. There's a saying when it comes to trading that the generals are shot last. The names that are showing the greatest relative strength tend to be the last ones to drop. They nearly never are completely immune to a market capitulation, but they are generally the last ones to fall. You see Apple drawing down, but not that bad. Microsoft is getting hit a little bit harder than Apple, but realistically, both of these names have held up better than the majority of the Qs, right? The majority of the names within the Qs are down anywhere between 60 to 90%. Microsoft and Apple are down, but not that much. So XLK is inherently going to look worse because you have a more concentrated tech focus on here, which includes a lot of those 60 to 90% drawdowns. But Microsoft and Apple are holding up reasonably well. So right now we're looking at the XLK ETF. We're thinking about tech. What do we think here? Well, the Qs are telling us growth is bearish. XLK is telling us, yeah, you know what? So is tech. Tech is bearish as well. We have a couple levels here that we were looking at within TTI. Once again, they mimic a lot of what the Qs were doing. We wanted to try to get short XLK related names, tech related names below 150 area, and we were able to do that, which we'll go over in a second. What are we looking at in the future though? We can see that almost the same sort of level shift down that we did with the Qs, right? We have this level at 130-ish area. We have a level at around 125. These directly correlate to previous price resistance on the way up. Obviously turns into support on the way down, right? RSI, once again, since the beginning of April has been oscillating between 50 and the 0. That's what we like to see in a bearish momentum regime. So what do we expect XLK to do? To be honest with you, we expect it to continue to draw down to probably the 130, possibly the 125 area. The 2020 highs, which is where most of these names are finding support before bouncing with any sort of significant volume, is all the way down here at 103. Do we think XLK can get all the way back down to 103? Reasonably, I don't think it's out of the realm of the ordinary. Let's go ahead and add one more level here, that 110, that's very obvious. I don't think it's out of the realm of the ordinary. We didn't expect a lot of names to capitulate as hard as they have, particularly things like ARC. I mean, these things are down below their 2020 lows. So who's to say XLK can't complete the round trip and give everything back up to around the $100 area, $103 area? It's very much reasonable to assume it can happen. But we don't try to predict, we only try to react. And right now, the levels that XLK is trading in 135-ish area, you're trapped below the 145 and you're above the 130. This same idea as QQQ. This is going to be a relatively risky area to open up shorts here, because where on the chart are you wrong? Are you wrong above 148? Well, that's quite the move. If you're an options trader, you're probably going to lose the majority of your premium. Do you play the 140? It's just very risky to open shorts here. If you're in shorts, you're in a fantastic place to continue to ride this trend to the downside down towards 130. If you're looking to open shorts, once again, like the Qs, you're going to be at a higher risk of opening them. All right, so XLK, your tech ETF. Let's look at consumer discretionary here. This is even worse. Now, the two biggest names in consumer discretionary are Amazon and Tesla. And I don't have to show you guys, but I will. We did make a video on shorting Amazon on this channel. We were too premature, right? We were targeting the area that I was just talking about in March, where we tried to open some shorts when the Qs broke down, but we got stopped out, and that's fine. Nobody in the group, I believe, actually opened up an Amazon play. They were very expensive, and there just wasn't a lot of open interest and volume on the names that we wanted, so we did avoid shorting Amazon, but the idea was still there. Retail looked like crap, Qs looked like crap, and this had been range bound for like 2 years straight. We finally broke that on a horrific ER report with bad guidance, and now we're back to 2020 highs. Amazon has completely given back everything that it made during the COVID run-up. It's hard to imagine that. Let's look at Tesla really quick. Obviously, it's fared better, but it is drawing down right now, giving up that 100 or 1,000 rather dollar pivot area. Our pivot is around 900. Most people are looking at that 1,000 area as if it's above 1,000, we want to buy it. If it's below 1,000, we don't want it. We're looking at the 900 area because it coincides with the 2021 high. That's it. If we're below this level, we want to be bearish Tesla, potentially short it. Now, we don't actively trade Tesla a whole lot because it's a crowded trade. It's harder for swing traders to nail these trends right now because of the volatility. We try to stay out of stuff like this. But Tesla below 900 for us is in bear territory, and that directly correlates to the consumer discretionary ETF. Amazon and Tesla both together, I believe, are around 30 or 40% of the ETF. So it's very highly concentrated in those two names. You're going to notice, just like the Qs, XLY had around the same levels, right? We wanted to be short XLY below 184. And so obviously with Amazon and Tesla capitulating, more so Amazon, the entire consumer discretionary sector has capitulated. And if you don't believe me, we can look at the equal weighted consumer discretionary, where everything is equal to about 0.75% of the total fund, including Amazon and Tesla. So not one stock is necessarily much larger than the other. The equal weighted consumer discretionary is only, what is this, 2, 3, 4% away from its 2020 highs. That is telling. So going back to XLY here, do we have more room to fall? Yeah, absolutely. XLY is about 10% off of its 2020 highs, being led down by Amazon, which is already there. Tesla is in, I don't want to say free fall mode, but it's in bear territory. Yes, consumer discretionary has a chance to continue to the downside. And like I said, we wanted to be short XLY related names below 185. It's served us well, this pivot spot. Just going back towards 2021 and seeing the range high breakout, we wanted to be long above that. We want to be short below the same area, right? It makes sense to us. And once again, we tried to go short on the break below the 165 area in April, which we'll go over in a second. But XLY, I believe, is the second worst performing sector. This consumer discretionary sector is the second worst performing year to date over every other sector. And the last one we're going to look at here, which rounds off the growth related names, is XLC. This is your communications related ETF. This has just been in free fall mode. Think of names like Netflix, think of names like Disney, think of names like Facebook. I mean, this has just been absolutely tattered from all-time high to where it is right now. We've sold off nearly 33%. Now we are testing those 2020 highs already. This is the first sector that has completed its round trip from the pre-COVID high. So it's giving back every single thing as a sector that it gained during the COVID run. And we wanted to be short XLC below 65. We didn't really mess with XLC a whole lot. We just had our eyes in other parts of the market. We knew that it was drawing down. We knew that it was going to negatively impact growth-related stuff. But the real pivot spot that we chose as a group to get short was a 64.50, 65 area, which coincides with around the same April breakdown. There wasn't too many of us that grabbed things within XLC. We tried to grab a Facebook position, and it just didn't play out for us. We ended up closing that for a minor loss. But here we go, XLC giving back everything. These are the three biggest ETFs, the three biggest sectors within the growth area, right? All three of these are in straight up downtrends, showing us potential continued moves to the downside. So buyer beware. If you're buying these dips and you're a trader, specifically a shorter term trader, be very, very careful buying bounces and dips because you just don't know where the floor is. So if we go over to Koyfin, we can actually just look at this really quick. Before we go over US sectors, I want to look at factor analysis, and I want to paint a picture for you really quick. How did we know within our group to consistently look to short growth and potentially long value? We go back year to date, we can see that value has outperformed SPY by 8.28%, whereas growth has drawn down 10.19%. Year to date, this has been a year-long trend. We're in, month number 5 now? Nothing has changed all year. We have been looking to go long value and short growth essentially all year. Now, we did pick our spots in both of those. We have not been full 100% long and full 100% short the entire time, but this is a great starting point. Where should you be looking to go long? Where should you be looking to go short? Long on the value side, short on the growth side if you are a swing trader. Let's go over to the size versus value. One thing I want to point out, once again, large cap value is up against SPY 10.27%. Think to yourself what you can imagine as a large cap value name that could be propping this up against SPY. If you're thinking majority energy related names, you would be right. Energy, obviously, which we're going to see in a second, has outcompeted every other sector year to date. It is up huge. It is skewing everything to the upside against SPY in regards to large cap value. We have mid cap value, and then we have small cap value, and that makes sense, right? We know that value is outperforming and growth is underperforming. So it makes sense that large, mid, and small caps have outperformed against SPY, year to date. The one thing I will point out, though, is that large cap value are generally large energy companies. Small cap value has a lot of smaller banks, some smaller energy related names, and this has not been performing as well. So just because we say value is outperforming growth does not mean all of value is necessarily outperforming the market index. There are some weak areas of value, which we'll see in a second, all right? The other point I want to bring out is that small cap growth, right? You have large cap growth. I told you, or we had mentioned that Apple and Microsoft, they're drawing down, but not as bad. Generals are shot last. You have mid-cap growth. A lot of the recent IPOs and stuff, which have sold off recently immensely, are a part of this area. And then you have the small cap growth. Now, for future you, whoever this is listening to this, if you want an edge in the market, when IWO, your small cap growth name, is leading the market to the downside, that is a very, very big sign that growth is in capitulation mode, or at the very minimum, risk off mode. All right. You do not want to be longing growth with your entire portfolio if the riskiest part of the growth sector is leading the market to the downside. If anything, you should be looking to short it if you want to play. Most people probably should just be sidestepping the whole thing. Do not buy growth if you are a shorter term trader if IWO is leading the market to the downside. Conversely, if it's leading to the upside, that inherently means a very risk on market, and you can and should be looking at allocating some of your trading capital to the riskier parts of the market because it's leading the market. And generally speaking, IWO is leading in a bull market. You should be looking to deploy more capital, right? So right now, IWO leading the market to the downside is telling us stay the hell out of going long growth. It's been telling us that all year, and we've successfully done that for the most part. We have not lost virtually any money, relatively speaking, on going long growth this year. We have not really gone long growth, and it starts with this IWO. We know as a group that as long as IWO is trending to the downside, growth is in a very bad spot for being bought. Okay, so the next thing I want to look at, it's only going to take a couple seconds, is U.S. sectors year to date. We know XLE is up the most year to date. We did have a pretty nasty drawdown over the last 3 or 4 trading sessions in energy. We were up near 50%. Now we were only up 37.45%, but the painting is on the wall. The writing is on the wall. The energy was and still continues to be, at least for a few more days, the place to be long. Energy is legitimately the only sector that you should be long with any sort of weight based off of year-to-date performance. At the bottom here, XLRE is slipping. We did not go over XLRE, and I'm not going to go over it in this video, but it is slipping bad. It's down about 21 to 22% in 21 days. So real estate now underperforming against the market index SPY. But there you have it, XLK, XLC, and XLY, all underperforming the market. And remember, specifically for you TTI traders that are listening to this and the future ones that may be interested, to beat the market, you want to be buying the things that are beating the market. If XLK, XLC, and XLY are losing against the market index, there is no scenario where you should be buying these to the long side. Not at all. We focus on buying winners and selling losers. So if anything, because XLK, XLC, and XLY are underperforming against the market index, that gives us more determination to short where we can, put a little bit more size into the shorts when the opportunities arise. And it looks like as of today, XLY has slipped below XLC as the worst performing sector on the year. It has lost 26.90% year to date. That is crazy to me. Once again, it's majority Amazon and Tesla. Last thing here on Koyfin U.S. Industries, I want to point out, once again, energy is up. OIH, XOP, AMLP, those are the 3 biggest industries year to date. Those are all energy related. And then at the bottom here, FDN, which is your internet related names. Think PayPal, think Amazon. PBW, which is your clean energy. It's all crap anyway. Sunrun, stuff like that. And then IGV, software related names. You know, things like Apple, things like Microsoft, right? So you have the 2 biggest growth areas within IGV and FDN leading the market to the downside. PBW is also going to be considered growth. ITB is going to be considered consumer discretionary as it's a home builder ETF, and we know that XLRE is dipping hard right now, so ITB following makes sense. All of these industries are below the index, below SPY. Look at semiconductors down 27.67%, whereas SPY is only down 16.37. This is why we are able to gain an advantage when we're looking at which areas of the market to long and which areas of the market to short. So the last thing I want to point out are 2 or 3 trades that we actually did take, and we're going to start off by going through, we'll use SMH because that's on here, so we can actually go through SMH. And we can see the performance. We know that SMH is down 27.67% year to date. It's below SPY. We know we want to be trying to go short names. Let's go through Koyfin really quick and see year to date what areas of the semiconductor space make the most sense? Well, as we noticed, we want to be buying things that are in downtrends if we're shorting them, right? I shouldn't say buying them, but we are. We're buying short positions. We're buying puts, right? So if we're looking to position ourselves to capture short or drawdowns rather, and we're looking to go short either by shorting the stock or buying puts or put debit spreads, however you want to go short, we want to look at what is dying the most here. And at the time when we opened up these shorts, we had to find charts that had already not capitulated. You don't want to be buying shorts that are already down 50, 60% when there's no clear risk on, risk off levels, because where are you wrong on the chart? That's the hardest part when you're looking to trade based off of technical analysis. You know, your greatest edge is you have a spot on the chart that says, whoops, I'm wrong, I want out. If you can't identify that spot, there's no point in going into the trade. So we went through every single one of these names that made sense. We double checked to make sure that there was open interest and volume on the chain for the guys that are trading options, and we stuck with TSM. So we're going to go through TSM really quick just to give you an idea of how we break down our trades. Here it is. TSM, as you can see, we have the whole thing laid out, a little Wyckoff market model theory with the markdown incoming here. We have the horizontal level breakdown after range bound for over 1 year. Actually, this is about a year and a half almost that TSM was range bound, and then we finally get the breakdown below the horizontal level. Now, we did not originally catch it in February, but I do want to point out, if we look at the semiconductor space like we just did, semiconductor space was drawing down just like the Qs, just like XLK, just like XLY. The entire growth space was under siege, and we were starting to create lower lows. So we knew semiconductors were already in a drawdown, right? So we knew that we wanted to be looking for a spot to go short that made sense. And by the time we had already looked at TSM, we had already broken through this level. So at that point, we're thinking, okay, do we want to short TSM randomly, or do we want to wait for another range to be found? Well, if you've been trading with TTI or any sort of amount of time, you know that this is somewhat of a rounded top. It looks kind of ugly, but it's just a pattern. It's a very frequent pattern in a drawdown where price finds a temporary floor, attempts to recover, and then test that floor again. Now we can play that breakdown, which is what we did. We entered somewhere around here. We held through ER, which inadvertently caused TSM to pop up. It never took us out on our risk off level, which was 110. I keep talking about risk off levels. If you're shorting the $100 area and you have your stop somewhere above 110, there you go. You have two levels to play off of. This is why we particularly chose TSM. Easy levels for risk on, risk off. And then also we have the entire year-long consolidation. We know the longer the base, the bigger the breakout or the breakdown. So we shorted TSM on the potential breakdown below 100, held through ER. We knew semiconductors were drawing down. We knew growth was drawing down. The market gave us a wonky print on some not so great ER because it's the market. It's a casino right now. Who the hell knows? It did not break our risk off level. We continue to hold, and this trade is now up over 100% for the majority of the guys in the group. You can see how we're still managing it. We're oscillating below the 50, 0 on the 50 here. This is a fantastic trade. We bought September's. Our first price target is $87. We hit it yesterday, so we did take some profit on this and tried to turn it into a free trade. And we have all the way down to that $60 area with plenty of time. That's the best part. We bought September's. There's no reason to be closing this early, specifically if you were able to make this a free trade. Now, we do have an argument over here that it's going to take a little bit of time, I'm assuming, to get through it around $80. But once we do drop below 80, we have nearly a parabolic move to the upside, which offers a low volume node for the guys that are using VPVR. But in classical TA, these parabolic moves are generally viewed as an opportunity to short because there's not going to be a lot of buying pressure here. There's not going to be a lot of people with bags here. It was just a quick move to the upside. So when we get down, if we do break below 80, I expect a fast move down towards 70 to 65. And if we do touch 60, which is your 2020 high, pre-COVID high, this is going to turn into a grand slam trade. It's already up and over 100%. It's already a free position. We have like 4 months left, 4 months left on this to mature down towards 60%. I would assume that if we do end up getting down towards 60%, this trade's going to turn into a 5, 6, 700% trade. So that's why we took the TSM short. That's how we found it, by taking into consideration industry and sector weaknesses, going through the actual ETF, the semiconductor ETF, finding all of the applicable names that gave us nice risk on, risk off levels, taking the trade, understanding that it took a year to break down, so we bought a lot of time, understanding where price targets are, understanding the arguments on the left side of the chart. This is all part of the TTI swing trading system, and this is why we were able to consistently maneuver through the market without taking too many huge losses. Everybody takes losses. We've taken our fair share, but we try to limit those. We put ourselves in to the best positions we can depending on the analysis that we can go through as a group. So I hope you guys learned something. I know this ended up being a way longer video than I expected. We went through all the 3 different growth sectors. We went through semiconductors in particular, and then one of the trades that we're currently in within TSM. So if you have any questions, feel free, drop them down below. If you're interested in joining, link is down below. Read through the landing page. It's worth it. Watch the video. If you have any questions, you can always reach out. I look forward to hearing from you, and I'll see you in the next video.